Welcome, everyone. Africa is home to some of the fastest growing economies. It has immense natural wealth and the world's youngest and most dynamic population. And yet, when African countries seek to borrow on the international markets, they often face interest rates up to 5 times higher than other nations. And not because they have done anything wrong, but because they operate in a system that doesn't fully reflect their progress or potential. My name is Stefan Exo-Kreischer. I'm the Executive Director for Europe for the One Campaign. We are an advocacy and campaign organization fighting to unlock investments for economic opportunities and healthier lives on the African continent. And I'm happy to welcome you all here to the Future Talk, Enhancing Access to Capital for Africa Through Credit Rating Agencies. Credit ratings are not just a technical tool. They are some of the most powerful gatekeepers in international development. They influence which countries get access to global capital, how much they pay, whether investors will show up at all, and whether reforms are seen and rewarded. And I think ever since the COVID-19 pandemic and the ensuing economic crisis, which hit Africa much harder than the health crisis, the debate around credit rating agencies as an integral part of the international financial architecture stepped out of a niche and into a broader spotlight of international policy dialogues, to a degree even international public dialogues. They've been discussed in various fora. In fact, the former Chancellor Olaf Scholz, in his opening speech to Hamburg Sustainability Conference 2024, dedicated a few minutes of his opening speech to credit rating agencies. They're discussed at the UN, at the G20. The AU just commissioned or tasked the African peer review mechanism with establishing an African credit rating agency, something that's also been in the news. So it is being debated more and more, and not just a technical niche issue anymore. And also you have to give credit to credit rating agencies, because in the recent years, they have taken steps to improve transparency, to improve engagement. Yet many African countries still face major hurdles, from disproportionate downgrades and lack of ratings, to data gaps that inflate perceived risks and borrowing costs. And that's why this talk today is so important. Because if ratings affect capital and capital affects development, then this is not just a financial issue, it's an issue of justice. And if you believe, like I do, that the development on the African continent is of vital importance to development in Europe and globally, then this is not just an African topic, but it is a global topic. So today in this session, we ask how better engagement with credit rating agencies, improved data and greater fairness in global financial system can help unlock more affordable capital for African development. And we are joined, and I ask you to come to the stage, by an esteemed panel of remarkable experts. We have Daniel Cash, a senior fellow at the United Nations University Center for Policy Research. We have Matt Robinson, a global lead on development finance at Moody's Ratings. Leticia Ferreira-Sestorki, Director of Development Finance and Impact Credit, the Allianz Global Investors, and Dauda Sembene, CEO of AfriCatalyst, who is also part of South Africa's G20-led Africa expert panel. We don't have much time, so we all need to be very concise. And I believe, Leticia, you have to leave us a little bit early, if I'm informed correctly.
Scheduling.
So even more time pressing. So let's dive right in. And I would like to invite each of you to give a brief statement of your perspective of how improved engagement with credit rating agencies can help unlock more capital for Africa and development there. Daniel, maybe you begin. Thank you.
Thank you. I think it's good to start by saying it was on the agenda in the last HSC, and It's great to see it back on the agenda now to show how important this issue is. I think I'll start by giving a little bit of context. When a government is downgraded, it's not just an issue that's really felt on a spreadsheet, it's felt by human beings in their everyday lives. So that could be in classrooms delayed, in clinics underfunded, or even just reform momentum lost. So For African sovereign borrowers, as well as all borrowers, credit rating agencies and their ratings play quite a large role in determining their access to capital, investors' confidence, and also their fiscal capacity to serve their own people. Across my own work, across rating reforms, I've seen a small procedural shifts when institutionalized well can unlock major gains. African governments are implementing comprehensive debt frameworks, they're pioneering innovative climate financing instruments, but too often those substantive reforms fail to materialize in their credit narratives that markets can absorb readily. From my work across engaging with rating agencies, multilateral forums, and sovereign advisory efforts, I've seen just how quickly progress can actually stall when that engagement remains informal. But let me be clear, this isn't about assigning blame to anybody. It's about bridging communication gaps and restoring fairness. African countries are not asking for special treatment. What they're asking for is recognition when their progress is made. And I think here lies our greatest opportunity. Rating agencies like Moody's, as you can see here, are more open to dialogue than ever before. Our challenge is to transform ad hoc conversations and relationships into systemic engagement frameworks. That means potentially building engagement frameworks and charters between sovereigns and rating agencies, or developing readiness protocols for sovereigns ahead of their ratings to be better prepared. But at its core, essentially, this is about building trust, cultivating an ecosystem where all the parties have the tools to be genuinely heard, understood, but most importantly, respected. The objective is not to dilute rating standards or interfere. It's to strengthen the architecture of engagement itself. Because when we achieve this, we're not merely unlocking capital, what we're doing is constructing the foundation for a system that better serves sovereigns, but more importantly, the citizens that lie behind those balance sheets. So what I'll end with is that the ideas are on the table, but what we need now is a political space and institutional courage to turn engagement into expectation, but most importantly, to turn dialogue into design. So I'll pass it back to you, Stefan.
Thank you. Just pass it along.
I welcome everything that you say, Daniel. I think that's absolutely spot on in terms of the importance of the issue. And we at Moody's, we don't see it as, to echo you, Stefan, we don't see it as a cost of capital for Africa issue. We see it as a cost of capital for frontier markets more broadly, and the extent to which it consumes scarce resources that would otherwise be devoted to development purposes, health, education, whatever it is that is essential for the people of the country in question. So we welcome the opportunity to engage and to be as open and transparent as possible. What's important is it's our responsibility to assess the credit risk. It's not a judgment on right or wrong. It's not a what should be done or what shouldn't be done, just the likelihood of being repaid on time and in full. That's it. That's all a credit rating is. We did do a recent report that we published on credit ratings in Africa and the cost of capital in Africa. And from an individual ratings perspective or at an individual rating level, it wasn't obvious that the cost of capital necessarily differed that substantially from other frontier markets, but definitely there is a higher cost with a lower rating level. Agreed, understood. And there's also other risks that come with that. The reliance on external financing brings with it foreign currency risk and volatility. The reliance on domestic financing when you've got very shallow capital markets, macroeconomic imbalances, high inflation levels usually leads to a higher cost of domestic financing as well. And that is challenged or aggravated further by the very low revenue generation capacity in a lot of frontier markets, Africa included. It's not our remit to prescribe what governments should do. But we do recognize when governments are making the efforts and are improving their creditworthiness. We publish research when we've seen some of these frontier markets, particularly in Africa, achieving some of the organic reforms like tax reforms, fiscal consolidation, revenue generation, improvements outside of the tax remit, operating environment, legal frameworks, banking system reform. These are all areas where low-rated sovereigns have achieved credit improvements, and we've recognized that in ratings upgrades. We've also seen where inorganic or external opportunities have come in, like guarantees being provided or other financing instruments that help local currency issuance and deepen the capital markets. And they're all the things where we consider we can be a constructive part of the discussion. And it's not for us to help, but at least indicate where it's occurred and how important it's been from a credit perspective, so others might emulate that.
Thank you. And again, just pass it on in the interest of time. Letitia, please.
Sounds good. Well, thank you all for having me. So maybe to take a step back and give a slightly different perspective, or where my thoughts and opinions would come from, is that I work for an asset manager. So we constantly talk to investors, on private investors as well as public sector investors. But I think here we'll focus a bit more on the institutional capital, as to what is it going to take for them to come into investment strategies that are focused on emerging markets. So what do they need? What are they concerned about? So my perspective is really coming from when we talk about private capital mobilization in the past couple of days. I get the question all the time, why is Allianz not doing more? What can we do? What can we do? Private sector is essential. And I agree. I think we just need to kind of go back to the fundamentals, and I'll tie it to the credit rating in a second, in that investors are quite biased, I would say, have a very strong home bias. So many of them that are sitting in Europe, insurance, pension funds, they know Europe, they're comfortable with Europe. That's the exposure of the majority of their books. So when we come and say, well, come and invest in emerging markets across the African continent, the first thing that they hear is, oh, wow, the media is telling them about political unrest and instability and volatility and coup d'etats, and this is all they know. And then when you look at the credit ratings associated with some of these governments, is triple C's, maybe a B minus, and a wild triple B, really too, I think, across the continent. So when you combine the already strong perception of risk, which is not always translating to the direct risk that we're seeing in the continent, to the fact that, of course, there's the ratings from the countries that have ratings, the countries that are externally rated, there's already that, it's almost like a confirmation bias, if you will. So it becomes really hard to have a conversation about them mobilizing a significant amount of capital towards the continent. And I think what's important to highlight here is that investors are really looking at risk return. So when you think about the risk, they think the risk is here. Even if it's here, they're already expecting a return that is way above what the continent can produce. So when we think about risk and when we think about credit rating agencies and the work that you guys do, I think it's really important to also tie it to what's the expectation of return, and that's also directly linked to the cost of capital. So if something is rated at a specific level, that translates into how much capital do you need to hold against that investment, and that translates into what is it going to make it worth it for you. And my challenge is that every time we go to investors, they tell me, oh, I want to make 50% IRR, because their perception of risk is so high. So I think going back to why is engagement with rating agencies really important is that it really translates into, it has a direct impact on how much capital is flowing, in this case, to the continent, as we're talking about Africa. So we really need to think about how can we engage better, and how can we be more transparent about data? How can we really share more perspectives and think about the quantitative and qualitative aspects of ratings? Because that directly translates us into what's the return expectations that investors have, and really, to be quite blunt, whether it's worth it for them to even bother looking into whether to invest in Africa. So I think we always need to keep that perspective that there is already a very strong bias, and we're fighting against that bias as a first step. So I think rating agencies and the work of credit ratings can be really important in helping push that bias and help us mobilize the capital at scale.
Thank you. The issue of narratives is a really important one. There are studies that show that media bias against Africa, I would say, just costs the African economy billions. So yeah, spot on. Please.
Well, thank you, Stefan. I think when we're talking about the importance of why enhancement in the engagement of credit rating agencies with African countries is important, we have to keep in mind that this has a bearing on the ability of African government to improve the life of their population. Why? Africa, I think there are two undisputed facts. Africa is the region where the cost of capital is the highest. Africa also is the region where progress toward the SDGs is the slowest. So, and there is a direct link between the high cost of capital and the inability of countries to make adequate progress toward the SDGs. So, if you have any way to reduce the cost of capital, indirectly you're saving life, indirectly you're improving living conditions. So the reason why it is important to improve engagement with credit rating agencies is because it is a potential way to improve the ability of African countries to lower the cost of capital. Because credit ratings assessment are important. They have a direct implication on the cost of capital. And the reality is what we have seen from the experience of our own organization, AfriCatalyst, which has been actually implementing with some partners, some dedicated initiative aimed at very much helping African countries to better understand the credit rating process, but also to better engage with credit rating agencies. What we are seeing is this is very much critical in not only allowing them to very much understand how the process works, but also in very much identifying ways to improve their engagement with credit rating agencies. And we have not been only doing it with African countries, but also with credit rating agencies. Someone said that they have been improving their engagement lately. This is very much critical, and I think this is something that we didn't see in the past. So what we are foreseeing is by very much engaging with stakeholders, starting with governments, but also advocates and civil society and all of that, credit rating agencies are able to very much understand their insight and very much able to very much improve their processes. They recognize that their processes are not perfect and they need to improve it, and they have been doing progress to that. By engaging with government and African countries, they can actually speed up that process because it is critical for them to very much understand how those governments actually sort of see their work and how they can very much also share the type of input and information and data that are needed to very much do their work. One last thing that I would say is that one thing that we have seen also as part of our experience is that many countries have not been able to very much understand not only the process, but very much engage well by providing them the information they need. So by improving that engagement, I think this is a shortcoming that we will be able to overcome and hopefully, of course, improve the ability of those countries to reduce the cost of capital.
Thank you. And I think what also is important to note is that when cost of capital is decreased and thereby more investments unlocked in the social fabric and infrastructure, then again, of course, the country becomes more interesting for private sector investments, and the return on investment and investments is greater. So there is a cycle, of course, that we need to enter in and maybe get out of the more vicious cycle of narratives influencing investment decisions, maybe also narratives influencing ratings. That would be a question also maybe to you if you would like to delve on that. Is there, because there is the criticism that some of the ratings, maybe especially the subjective part of the rating process, but also to a degree maybe the one that is more based on data, is also not informed enough by local knowledge, by local context knowledge, which is also, of course, something that I think is important, that it's not one market, but many markets. So maybe you could go a bit deeper on this and also say what do you think African governments concretely need to do, maybe in the short, medium, longer term, and also what you, from your perspective, would like Moody's and others to do even better.
Yeah, no, I think you're perfectly right, Stefan. One thing that we have heard over and over again from African government is credit ratings agencies fail to very much understand the reality of their own economies, and they're not necessarily reflected in their own assessment. There is a part of it that is definitely, of course, true. There's another part maybe that is fed on by a sort of a misconception. The reality is, if you are able to as far as African countries are concerned, as you're saying, if they're able to very much improve their credit profile, they would be able, of course, to very much get better ratings. And how do you do so? I think there are many ways. First of all, you have to understand that credit rating is essentially an opinion on how a country can repay on a timely basis and in full. So if you're able to very much improve your credit worthiness, you should be able to get better ratings. And how do African countries can do so? I think it is understood that they can do it by improving their fiscal management, their debt management. They can also do it by improving their statistical sort of systems. They can do it also by very much reducing whatever is able to sort of increase the risk or credit risk that those economies are facing. The reality is, the problem is Africa is not only faced with actual risk. What is also very much being said, or that we hear from many African countries, is there is also perception of risk that is also being channeled through some credit rating assessment. Is it true or not? I think that's not the question. The question is how we can address that. And I think it comes back to what we were talking about earlier, about the need for improved engagement between all stakeholders. It's the government on one side, credit rating agencies on the others, but also other type of stakeholders that are also very much involved. One other thing that I would add is, if very much you want to improve credit profile in African countries, of course, growth is the best way to go so. But to do so, you have to address, of course, the many issues that they're facing, including the high depth of growing debt vulnerabilities. But if you ask me, the reality is it's not only African countries to very much address those issues. It's also credit rating agencies to very much understand and see that there is a need to be more transparent in their methodologies, and you have to actually recognize that a lot of progress has been done by many big three sort of credit rating agencies in putting together out their methodologies. But I think one additional issue that needs to be addressed is how, as part of the process, you can also shed more transparency in the work of credit rating committees. You may actually have great methodologies, but if at the end of the day the decision is taken through a voting majority by a number of people without necessarily a lot of transparency, I think there is an issue there. And I think one last thing that I would say there also is, I think it is critical to know that it's not only African countries, or actually it's not only by addressing the credit rating issues that you can solve the cost of capital. It's just one part out of many other sort of moving factors that needs to be addressed.
Thank you. Yeah, it's one part of a bigger puzzle, but an important part. That's why we're here speaking about it. So thank you. I would say, summarizing, capacity building on the one side, better data provision, and other things that you mentioned, but also on the other hand, again, tackling the negative narratives that do lead to perceptions that might be skewed. And again, more progress, and acknowledging the progress that has been made on transparency and on the ways of working within the credit rating agencies. Matt, do you want to come in on those points?
Yeah, look, I think all the points that are made are fair. And part of the reason why we're here doing exactly this is to subject ourselves to the same level of scrutiny that we subject the governments, the corporations, the banks, when we are conducting our rating activities. We don't stand before you and say we're infallible. Indeed, we welcome the feedback from stakeholders, because this is how we improve our processes. This is where we understand where we think we're being transparent, but we're perhaps not conveying the information in a digestible format in a way that the stakeholders are able to consume that. We do make, I'd like to think, a very decent and honourable effort at being as transparent as possible, whether it's with issuers. One of the benefits post-COVID is the fact that so many more people are available for virtual meetings, so we can have a lot more discussion, a lot more fruitful discussion than just the usual once a year in country where you're on the ground having a more fulsome face-to-face meetings. But we also offer transparency presentations to our issuers. That is, after a rating action or on demand, we talk about the drivers of the rating action, what we see the individual elements of the credit profile and why we've taken the actions that we have. May not necessarily agree. That's not the point. The point is not to convince a government what that we were right. That's not the point. So that they can understand why we took the action that we did, whether it was in a positive or negative direction. And as I said, why we've taken actions elsewhere in case studies that others can emulate. We also have committed to conducting regular reviews every 6 months. We publish either a rating action or an announcement of the periodic review following a rating committee so that the market is kept well informed as credit evolves over time. We publish immediately after that a credit opinion within 3 days that goes into a more granular detail about the individual elements of the credit profile in a way that issuers can challenge us. Do we understand it? Do we appreciate it appropriately? Have we missed something that they consider to be important? Investors certainly challenge us, whether or not we are picking up on the right elements that are underpinning our credit assessment. And we've also started engaging with other stakeholders, the broader stakeholders in the Africa space in particular, like the Africa Peer Review Mechanism, like the UN Economic Commission for Africa, those that are busy setting up the mooted African Credit Rating Agency, offering insights into our methodological processes, why we consider certain elements to be important from a forward-looking predictor of being repaid on time and in full, and why we have the methodologies that we have. Through that process, we're constantly getting feedback in the other direction, and we do periodically revise and review our methodologies. We publish a request for comment, inviting stakeholder feedback as to where credit has evolved and whether or not certain changes need to be made. The last time we did that for sovereigns was 2022. We're in the process. We published a discussion paper on multilateral development banks in August last year, looking at some of the key elements that are important in the Africa space. We've just expanded the remit of our closed-end funds methodology to respond to the specific feedback from investors that this was only relevant for corporates. Well, now it is expanded to public project finance in the public space, and also relaxed what was a previous threshold of 5% limit on emerging markets. Now it can be up to 100% emerging markets for closed-end funds. So that's where we're responding to the feedback. And maybe one final point, the point about rating committees being a black box. One of the most innovative innovations that we've tried to bring in from a transparency perspective is what we call a rating committee simulation workshop, where we try and emulate through a fictitious sovereign the kind of discussion that goes on during a rating committee, the roles and responsibilities of the various agents in committee, and embrace the feedback from the audience saying, well, why do we do this? Why have we done that? How have we come to the outcome? Who has what responsibilities? And I think that's a really good way, keep an eye out for it. That's a really good way to understand how we do our job.
Yeah, interesting. Letitia, I mean, from your perspective of investors, where do you see the most pressing issues to move forward in terms of making progress on this important issue? In terms of what do you see from, for example, African countries? What do you think needs to be done more from credit rating agencies? What would be helpful for you and your clients and your partners?
Yeah. I think from maybe my perspective is slightly kind of above the chain, and that I completely agree. I mean, I think from being a player in this market, if you will, it is very important to engage. It is very important to have as much transparency as possible. I do think that investors see ratings in general as kind of equalizers, if you will. Whether you agree with that or not is up for discussion. But in some ways, they see like this is a AAA, this is a BB. This is what's going to drive my cost. This is what's going to drive my return. So I do think that, or the return I expect, I should say. So I do think that is really important to have that transparency. I work as part of a private debt team, which obviously makes ratings really important, but at the same time, not very immediately available, because there's a lot of corporates that are not rated in the markets that we're investing in. Capital markets are not very developed. So while rating agencies, the work that you're doing, Matt, is really important, in some ways, we often find ourselves in having to understand the risk through the data that is available. So maybe a slightly different, maybe a response to the question asked. And that's why also having transparency is quite important, because the African, if you're looking at an African sovereign, I might not be lending directly to this sovereign, but at the end of the day, that sovereign is establishing a cap on how can the corporates in that country be rated. And I have a minimum borrower rating that I can lend to. So in some cases, the corporate I'm providing the capital to might not be rated, but then we look at the sovereign and the fundamentals of the sovereign to understand what's happening in the country. So that's where that transparency will be quite important, of us understanding the dynamics and what can, I think the rating levers or levers of what can improve and what can, make the credit worse. That's something that we do look at in our evaluation. I think one point, and I don't want to deviate from the exact conversation, but to give a slightly different point of view as well, is that when we think about mobilization, investors are not only driven by the cost of capital and the return and how much they're willing to lend at. In some ways, we also face the reality that some African countries, many corporates there are risky, and the rating agencies, the work that you do and the ratings that are assigned might indeed reflect more or less fairly or less fairly the risk that investors are exposed to. So what we do is then we structure around that risk, and that's where I do quite a lot of blended finance. That is a term being used quite a lot around here, and that's where we are also working with rating agencies. So taking a step above from the borrowers, where I think my fellow panelists are very well placed to discuss, we're taking one step up and say, okay, this is the risk. Let's discuss if it's fair or not fair, but that's the reality we face. How can we structure around it? And how can we work with rating agencies to help us with this financial engineering? So if I'm putting together a blended fund, for instance, can rating agencies help me rate that structure such that investors can then invest? So if they're not going directly lending to an African sovereign and they're going through a blended fund, can we think about new methodologies and be creative around these kind of de-risking structures that then will allow capital to flow? So maybe it's slightly different. We're not going directly to the borrowers, if you will, maybe through a fund, but I think that there's still very much truth in engaging, discussing, and something that we're doing with Moody's and the other agencies as well.
It's a very interesting construct to have like an alternative construct in order to circumvent some of the difficulties that we were talking about, sovereign credit ratings. So interesting. I'd say we talked about data transparency as one of the topics, I would say the buckets where progress has been made, but progress, I think there's still room for progress. We also talked about the fact that there needs to be a reflection of the diversity of the different markets that we have on the African continent, the narratives. We didn't talk about so much about the multilateral actors and enablers, and the IMF, the G20 expert panel. Maybe you could also say something about this and on the importance of supporting capacity building initiatives. But I would like to bring you in again, Daniel, and reflect a bit on what you heard. It sounded to a degree that everything is going into the right direction. We have made some progress, but I'm sure there are some issues where you would like to point your finger and maybe poke it a bit and say,
Is that my job?
There's not. Yeah, I'm trying to provoke you to take that job maybe, and tell us from your perspective. Here I'm beginning to be impatient. Here I think are gains that we can actually quickly realize and where we need to see action.
I think the important part is picking up what you said, Letitia, about it needs purposeful action. This will not organically fix itself. It needs structure to it. So we're talking about the relationships between the two parties. I often feel deeply uncomfortable because a lot of work needs to be done not only by the agencies, but by the countries themselves. I often feel deeply uncomfortable about that because the reality is, for example, the capital markets, they outdate a lot of these countries' history. If you think about a lot of these countries were in countries when the first Eurobond was issued, that should tell you about there's a gap, a lag between the necessary experience that, for example, Germany has where we are, and, for example, Ghana, because they just can't build that experience quickly enough to deal with the new environment they're in. With that aside, it really needs purposeful structure. And I think one thing we're trying to do, we're working through at UNUCPR, is trying to flesh out the ideas of something like a sovereign credit rating agency engagement framework, where it's purposefully structured with like a voluntary charter where they agree to come together in specific thematic purposes, for example, to get to the point where the agencies can speak more clearer to the countries themselves, and the countries can be in a space to receive it better, rather than what's happening now, which is the agencies are transparent, put it on the website, like you said, the many reports that Matt mentioned. That's just for the agencies to read and the countries to read and understand. That doesn't necessarily suggest that they have that capacity to fully take it on board because of that lack of experience.
How do we get there?
Well, you have to purposely structure it. You have to go out with a purposeful ambition. We will put this in place. And when you're saying about the role of the multilateral actors, that's where they come in, because let's say the MDBs are perfect for this, to host these types of things where it's not just training on a 2-day workshop and then everybody goes home. You have repetitive, consistent coaching to increase that lack of capacity that is on the ground. I mean, I've worked closely with Dada on the UNDP Africa Catalyst Initiative, and we saw that when we first started, just a core lack of capacity, which is nobody's fault, but it exists. And that's when you're saying that credit rating agencies are one component, they are, but it's a massive issue in terms of the relationship and building that capacity, because I honestly believe if you want more accountable outcomes, you need to make that dialogue more accountable. And when people show up, it can't just be we show up, we have a discussion, and then we go home. It has to be consistent, designed with an outcome in mind, and then that outcome is tested, back-tested, and then built on it throughout. So the purposeful actions that are happening in blended finance are a really good example of what we can do in capacity building to get some better outcomes.
And it's not done enough, I hear.
Absolutely not.
What do you think about this assessment as one of the most important things to move forward? Bringing in some more actors like the multilateral actors, the World Banks, the MDBs, is that something that you see? And where do you think we need to put pressure or convince to have more purposeful action like Daniel described? Please.
Well, thank you, Stefan. You mentioned that I am a member of the G20 Africa panel that was set up by South Africa, and I'm very much honored to be. Of course, I'm not speaking on their behalf here on this panel, but what I can say on that is it is very much critical that we think of the importance of reducing the cost of capital, not as something that only sort of is under the responsibility of governments and credit rating agencies. It involves an ecosystem of actors. So what are we talking about? When you're talking about cost of capital, you're talking about the issues that are related to the pricing, the assessment, the sharing, and mitigation of risk. And for each of those processes, I think there are different actors. So on the pricing, of course, credit rating agencies play a big role because of their ratings. That informs, of course, investors as they price risk. The IMF and IFIs also play a role through their debt sustainability analysis in the pricing of risk. But so if you want to really reform the sort of multilateral system, you have to see how you can facilitate engagement between all of those actors and, of course, government, and try to see how they can very much improve that pricing and make it at least not only fair, but also very much adequate. That's one. When you're talking about the sharing and mitigation of risk, you're talking about how you can also reform the global financial architecture so that MDBs, for instance, that plays a key role in that area, can do it in a better way. And I think so long as we are not able to address those issues, it's going to be very difficult to reduce the cost of capital, because I think what we might end up having is this situation where actually we have huge perceived risk, and sometimes that perception of risk is even more damaging than actual risk, and that's what is happening. So if you're able to very much put all those actors together and find the way to very much find the solution, and I think we will be able to reduce the cost of capital. One last point. I think when the MDBs under the G20 leadership actually felt like their callable capital was not value enough, the global community actually called the CRA, the credit rating agencies, MDBs, and all around the table, and they try to find a solution. We should do the same thing with also when it comes to cost of capital, when it comes to also how African countries are rated, and how the risk is priced in those countries. If we do so, I think there is potentially a lot of sort of positive implication that can hopefully facilitate their ability to mobilize low-cost financing.
Thank you. And there's a lot of hope, I think, on the current G20 process, which happens in a, let's say, very challenging environment. But I hope it will be successful. And I know that Germany is behind it and also trying to support as much as possible, of course, the South African government there. Before we go to the audience, I would like to give you two also the chance to react to some of the things that Daniel and Dauda said.
I think just very briefly, one of the topics that I think is really important when it comes to engaging is just data. I mean, Man and I are going to a panel. This is why I have to rush off to talk about how important data is. And I think this benefits everybody. So this is it's not about the rating agencies producing data. They need information to be able to make a determination. And I think that goes not just the African sovereigns, but also the current investors that are in these markets. What data do they have that they can share to better shape what the actual the continent, the cost of capital, the rating should look like? And that's essential for investors. It's essential for rating agencies, though I won't speak for Matt over here. But I think that's where we all need to engage and where the MDB community, MDBs and DFIs really come into play as having been investors in these markets for decades.
Thank you.
Yeah, I think on data, we're both a producer and a consumer of data, and calibrating our ratings, our risk assessment, it relies on the amount of data that's available. The amount of transactions that we can rate becomes its own data source. So obviously we're interested in a lot of the blended finance transactions, the guarantees that are being offered, or those elements that are able to adjust the risk profile in a way that it becomes tolerant to certain investors, that they can pick up and take the elements that they're comfortable with. And some other actors like the multilateral development banks or the philanthropic community are able to take the first loss or guarantee principles or some kind of insurance on other elements that investors don't feel that they are either equipped to ultimately deal with, or that they're not capable of tolerating at the returns that are being offered.
Thank you. So very difficult to summarize, especially when there's a flashing time. I think what we heard is that transparency is important, data, engagement, capacity building, really important. We need action on this G20 process. There's a lot of hope and expectation, of course, on that. But not only there, what we've heard is that I would say there's still a long way to go, but what is important is that along that way, there's progress being made, and we have seen progress in the past. So it is something that makes me hopeful, and especially because it is of such importance. And I hope we can maybe potentially meet here again next year at HSC, and of course at different fora in between, and discuss again the progress that we have made on the long way towards a better system where we can all then say it's probably not perfect, but it's as good as it can get. Thank you very much. Thank you all for listening, and hope to see you soon.